Welcome to the We Study Billionaires YouTube channel by the Investors Podcast Network. I'm your host, Clay Finck. On this week's episode of the We Study Billionaires Podcast, episode 524, I reviewed 4 wide moat companies and shared my analysis and research on those 4 companies and why I believe they have strong and wide moats. 2 of the companies I covered were big tech companies, Alphabet and Amazon. These 2 companies in particular, I think offer pretty good value in today's market for long-term investors. These 2 businesses have grown tremendously over the past 10 years, and they delivered exceptionally strong revenue growth and stock returns for investors, and they both continue to reinvest back into the business at high rates of return, which is something I always look for when analyzing a company. So during this episode, I'm going to use these 2 companies, Alphabet and Amazon, as examples of what I look for when I'm analyzing a stock to help give the audience a better idea of how I analyze companies myself, and then how I determine if I believe they're a good investment or not. I've had a number of people reach out to me asking me what tools I use to analyze companies and what sort of things I look for, so hopefully you'll find this video helpful. With that, let's dive right in. Before we dive into Alphabet and Amazon, I wanted to share my general process for analyzing stocks to give you a good idea of where I'm coming from. When choosing an individual stocks, my process is largely influenced by Warren Buffett and many of the other great value investors. Another investor that's had a big impact on me recently is an investor named Terry Smith out of Great Britain. He puts a heavy focus on quality specifically. So I'm looking for very high quality businesses in addition to some of the things listed here. In general, I want to take a long-term buy and hold conservative investment approach that will deliver a strong rate of return through the growth of the company's free cash flows. So walking through this checklist, first, I want a business that is simple and understandable. If you look at many of Buffett's greatest investments, they were really simple and understandable businesses. Really, anyone could understand them. You look at Coca-Cola and Apple. These investments went up, multiple times for him, and they were just really successful, and everyone knew about these companies, and anyone had the opportunity to buy them. Second, I want consistent revenue and earnings growth. I'm not trying to hit a home run with the next Peloton or next hot growth stock. I want to see, a good operating history, stable revenue and earnings growth over time that I can rely will likely continue into the future. Third, I want a strong moat and competitive advantage. This ensures that the company's free cash flows and earnings are going to continue for a really long time. You look at a company like Apple, people are buying their iPhones and their Apple products year after year after year, and they really don't even think about buying any of the other products. And Apple just has so many people locked into their ecosystem, and that creates a strong moat and a strong competitive advantage. Fourth, I want honest and competent management. I'll look at things like interviews they've done, their earnings reports. I'll look at the return on capital, return on equity, things like that to get a feel of how honest and how competent management is and how good they allocate capital for shareholders. Fifth, I want high return on invested capital. The average for the S&P 500, I believe, is around 8 or 10%. So I definitely want return on invested capital to consistently be higher than 10%. Usually I want it to be higher than 15% over the past, say, 5 to 10 years. So that's another thing I look for in my process. And then sixth, I want to buy at attractive prices. So I'm thinking about what is the present value of the company's future free cash flows. And I'm comparing those free cash flows to what the price that's offered today. And if I believe that the price today is lower than the intrinsic value of the company, then I believe that is an attractive price to pay. If you'd like to learn more about just Warren Buffett or a traditional value investing type framework, I'd encourage you to go back and listen to the We Study Billionaires podcast, episode 487. I dug deeper into Warren Buffett's 12 investment principles if you'd like to learn more about what he looks for in a company. All right, so let's talk about Alphabet. I have it pulled up here on our TIP finance tool on our website. Now, recently, there's been just so much chatter around Alphabet and Microsoft with ChatGPT and Microsoft trying to utilize AI to try and take share of Google search. Microsoft's CEO says that AI-powered search is the biggest thing to happen to the company in the 9 years that he's been CEO. And he's been quoted to say that he's not seen something like this since 2007 or 2008 when the cloud was first coming out. Now, Microsoft has been trying for decades to try and steal market share from Google search, but they've just failed dramatically so far anyways. Over the years, they've spent over $15 billion on Bing, only to meaningfully fail to tap into Google's market share of the search business. Just think about that, $15 billion, and they haven't been able to penetrate Google's moat. I'd say that if you're concerned about Microsoft potentially stealing market share from Google, then just go ahead and purchase Microsoft shares as well, because it's just as good of a company in my mind. And then you hold two companies that have invested some of the most money into the research and development of this AI technology and where the search business might be heading. Now, first, before we dive into the TIP finance tool for Alphabet, let's take a look at their 10K. I pulled it up here. And I went to the revenue section just to show you kind of what their business looks like today. So the first line here is Google search and other. It shows $162 billion in revenue. This earnings report was released just recently, the beginning of February, for their Q4 results. And as you can see, Google search revenue has just been straight up and to the right ever since 2020. They've really got a huge boost post-COVID for really their overall business. And you can see on the TIP finance tool that the stock price is up significantly since pre-COVID. It was $76, and at the time of this recording, it's $99. And the stock just dropped quite a bit today. I believe it was down 8% today after Microsoft announced that they're really doubling down on attacking the search business. Now, second here, it shows YouTube, which you can also see has seen substantial growth since 2020. It was 19 billion. Now it's 29 billion. Then Google Network is some of their other applications under their umbrella. That's grown from 23 to 32 billion. So really strong growth in all three of these. And a lot of it's just due to the advertising market. Digital advertising is a large part of Google's revenue. And that's a tailwind that they're really getting behind as more and more ad spending dollars is moving digitally. So next here we have, I guess it shows the Google advertising total here, 224 billion. And of their overall revenues of 282 billion, just under 60% of that is Google search. And they're kind of famous for their other bets division. That only pulls in $1 billion. And then what's really grown a lot over the past couple of years is their Google Cloud business. They've kind of been behind the curve in the cloud business relative to Amazon and Microsoft, but this business has been growing substantially as well over the years. And a lot of these businesses tend to be really high margin because of the scale and the network effects and the fact that they're software and they're digital. Once you set up the YouTube algorithm, the Google algorithm, you don't need a lot of maintenance expense or fixed expenses there. A lot of it's just research and development and trying to improve the product. So turning back to TIP Finance here, I can show you a little bit about our tool. Here at the top, it shows some statistics about the company. It shows their market cap's just under 1.4 trillion. The stock price should be around $98 after it adjusts for today. And then it shows the volatility. The momentum status is currently red. That looks at the volatility of what the stock has recently experienced. Shows the price to earnings, price to free cash flow, and some other metrics here. And then you can see that many legend investors own this company. Bill Miller, one of my very favorite investors, has almost a 4% position in his portfolio. Bill Nygren has a really big position, and many others. Tom Gaynor, Guy Spear own this stock, and then it shows the chart here. And then we can see the financials we were just looking at. They have 282 billion over the trailing 12 months of revenue. And for free cash flows, they have 60 billion. You can see that their revenues have increased quite dramatically over the past decade, from 55 billion in 2013 to 282 billion in 2022. So really, really strong growth as you see that tailwind to the digital ad space. And then free cash flows have grown from just under 10 billion to 60 billion. And that's declined over the past year or so because, when you have those recessionary pressures, a lot of companies are pulling back on their ad spending. Now, one thing to keep in mind here is that Google pays a lot of stock-based compensation. If you pull up the cash flow statement here, I just clicked this little button here next to the cash flow. This pulls up the cash flow statement, and you can see that the stock-based compensation for 2022 was $19 billion. And that's a real expense that should be considered when we're considering how much money the company earns. So that is something I will want to subtract out of this free cash flow amount when I'm determining the intrinsic value of the company. Now, scrolling down here, there's some key ratios you can look at. One ratio that I really want to look at in particular here is the return on invested capital. This is really, really important to me. Now, our tool shows that the return on invested capital has been over 20% over the past 10 years. And Charlie Munger really taught me that the returns of a business tend to revert to the return that the business owns on the capital it invests. So Google has consistently returned 20% for the money they reinvest back into the business. So that tells me that they have a lot of opportunities for growth. And the management team is really efficient at reinvesting capital back into the business to produce more and more income and free cash flows over the years. So that definitely checks the box of, return on invested capital being greater than 15%, which is really, really good to see. And then also seeing the free cash flows grow consistently year after year is really good. Revenue's growing. That's all really good and what I like to see from Google. Now, it's important to remember that I mentioned that the free cash flows have gone down over the past 12 months or so, and that's really because of the recessionary pressures. But I'm thinking as a long-term investor, 5 to 10 years down the road, I think Google's free cash flows and revenues will be much higher than they are today. So I'm willing to hold through any sort of pullback in any sort of recession and just weather through that storm. And the stock price will likely get hit as it has over the last, say, 12 months. I expect that to just be temporary and this business to continue to grow over the years to come. Now, the final piece I wanted to walk through here is our intrinsic value calculator on our TIP Finance tool. If you just click this little calculator right here next to intrinsic value, it pulls up our intrinsic value tool. So first, I'm going to have to determine what sort of free cash flow amount I want to assume for Google. The free cash flow amounts in the TIP Finance tool showed $60 billion for Google, and then it showed stock-based compensation of $19 billion. But I know that Google's doing a lot of reinvesting back into the business. If I were to estimate some sort of normalized earnings for them, I would take out that $19 billion in stock-based comp, and that would bring it down to $41 billion. And I'm going to adjust it up a bit to $50 billion to make it somewhat of a normalized earnings because they've hired a lot of people. They've been cutting a lot of employees, and they're doing so much reinvesting back into the business. And I'd say $50 billion is about a reasonable estimate of what I'd expect the business to earn today. So then I have to come up with some sort of growth figure to calculate the intrinsic value. The TIP Finance tool allows you to do 3 different bands if you want with different likelihoods. I'm just going to stick with one here. And let's just say that Google's free cash flows grow by 10% over the next 10 years. That's what that's doing here from 2022 to 2032. Now, what that does is it gives me an expected IRR of 5.8%, which definitely isn't that great. Usually with individual stocks, I want to shoot for a 10% or more. So maybe Google's going to grow at a little bit faster pace. Let's say if they grow at a 15% over the next 10 years, that would put their free cash flows at over $200 billion, which is quite a lot. And that would only bring it up to 8.5%. So to purchase Google, I would need the price of the stock to come down a little bit, and you're able to adjust the market price here. And I see it's at 107, even though the stock is trading at 98. So if I change that to 98, it brings the return up to 9.3%. Now let's bring this down to around 12% and see where that gets us. So that puts the free cash flows at over 140 billion in 10 years. And then if I purchase the company at a stock price of 98, that puts the internal rate of return that's expected to 7.2%. So you can play around in the tool here and see, okay, what if the stock goes down to 90? Well, that brings my expected return up to 8.3%. And then if I purchase it at 80, almost 10%. So I can mess around here. I did purchase some shares under the $100 range back in December in their recent dip. I think that was quite a good price to pay for long-term investors, and honestly think it's a reasonable price to pay for a company this high quality. So that's kind of an overview of our TIP Finance tool and Alphabet. Now let's move on to Amazon. All right, so I have Amazon pulled up here on the TIP Finance tool. You can see it has a market cap just over $1 trillion. And again, one of my very favorite investors, Bill Miller, has almost a 5% position in this company. And I recall him saying that he believes that Amazon's AWS service is worth $1.5 trillion alone, and overall market cap of Amazon is $1 trillion. So he's quite optimistic about the company. Let's look at their recent 10K, which is their quarterly report where they announced their earnings results. You can see that the online stores actually had a decline in revenue for 2022 overall. So the company's facing a lot of headwinds after having a lot of tailwinds after COVID. A lot of shopping went online when people were on lockdown. So a lot of people were doing shopping online that otherwise wouldn't have done any shopping or have never done online shopping before. The company's really seeing some headwinds for 2022 with the potential recession. And then you have the physical stores. Those increased to 18 billion. Online stores are 220 billion. Third-party seller services, this is up quite a bit. It's up over 37 billion over the past couple of years, totaling 117 billion. Subscription services, that's at 35 billion. Advertising, I believe that's going to be a really big business for Amazon one day. It's at 37 billion. And then AWS is their growth powerhouse, is growing really rapidly. It's up $18 billion alone in 2022. And as you'll see, a lot of Amazon's revenues are digital and based on software. And I believe long-term, these are going to be really high margin businesses for Amazon. But if you look at our TIP finance tool, you'll see that they're actually free cash flow negative. So Amazon is heavily reinvesting back into the business, and it looks like they're unprofitable, but I believe that if Amazon wanted to be profitable, they definitely could be just by dialing back their reinvestments back into the company. And I think the same thing applies with Alphabet as well. They could be much more profitable if they wanted to. So when I'm projecting out the free cash flows and saying, hey, I think they're going to have an 8% return, I actually think that's understated to some degree because the company is so heavily reinvesting back into the business and back into the future. For years, people said that Amazon was overpriced. They don't make any money. Their margins are too slim. But, Jeff Bezos was just relentless on thinking long term. And that's what I really love about Amazon is how the managers are long-term oriented. That's why I think a lot of value investors here own this company. Even Warren Buffett owns shares in Amazon. Warren probably didn't make that decision himself. It was probably one of his colleagues, Todd or Ted. But regardless, Berkshire Hathaway has a position too with Amazon. So again, I think Amazon could be really free cash flow positive if they wanted to be. So valuing the company is quite a bit different than valuing a lot of other companies because it's difficult to project out their future free cash flows because we don't really know what they're going to be. I just know they're reinvesting back into these businesses and growing the moat of the company. And long term, I think this company is going to be much bigger than $1 trillion business. So just looking over some of the metrics here, the price to free cash flow you'll see is negative as well as the price to earnings. I believe that's temporary as they work through the recession that may be coming up. They work through, reinvesting and figuring out some of the issues they've gone through with COVID, the huge demand shock, and then supply chain issues as well. So looking at their financials a bit, you can see their revenue is practically straight up and to the right. Total revenue is $513 billion over the trailing 12 months and for 2022. Simply incredible. And I honestly see a lot of growth ahead for them. You look at their advertising business, their AWS, their online retail stores. There's so many tailwinds for this company long term that I think it's just inevitable that it continues to grow just like a weed, like it has over the past 10 years. Revenues are up 7x over the past 10 years. That's just incredible and unheard of. And, this may become one of the greatest companies the world has ever seen. And it may already be in that discussion. So free cash flows, you can see it has been positive in past years. In 2020, free cash flows were 31 billion, but then it dipped negative in 2021 and 2022. Again, I think this is temporary. And you can see operating income as well. That's been positive. And after you factor in some of their other expenses, their earnings dip into the negative side. Then if I scroll down, return on invested capital isn't as useful as a metric for Amazon because they aren't showing much for earnings today. So you're not going to see, the company's high return on invested capital here on their financial statements. You'll have to make your own adjustments based on what you believe Amazon is receiving out of their investments. Just taking a quick look at the stock chart here, you can see it was around the $100 range in March 2020 and rose all the way up to nearly $200 here in late 2021. And it traded sideways for almost a couple of years. And now it's trading back down, and we're at around $100 at the time of this recording. And it dipped down to around the mid 80s. I do have relatively small positions in both Alphabet and Amazon. I'm very bullish on them longer term. I don't think these businesses are going anywhere, and I think they have just so many tailwinds behind their back, and they're just in industries that are going to continue to grow, and they are the leaders of those industries. All right, so that's all I had for today's episode. I hope you enjoyed it. I hope you found it helpful in understanding what I look for when analyzing stocks. Thank you for tuning in to today's episode of the We Study Billionaires YouTube channel. If you enjoyed this episode and would like to learn more about Alphabet and Amazon, I highly encourage you to go check out the episode we just released on the We Study Billionaires podcast. It's episode 524. I cover 4 wide moat companies, 2 of them being Alphabet and Amazon, and then I cover 2 other wide moat companies that aren't in the big tech space. I'll be sure to get that episode linked in the description below for those that are interested. And if you don't mind, if you would just click the like button really quickly and hit subscribe, that will really help us continue to grow the channel and provide this great content to you for free. Also, feel free to leave a comment below to let me know what type of content you'd like to see in the future and what you think of the video. With that, thank you so much for tuning in, and I'll see you again next time. Thank you for tuning in to today's episode of We Study Billionaires. If you enjoyed this episode, we would really appreciate it if you subscribe to our podcast feed using the link here on the screen. This will really help support the show so we can continue to provide this great content to you for free. We appreciate you being a listener and hope to see you again next time. As long-term investors, it is critical that the companies we invest in have a strong economic moat, which is simply a distinct competitive advantage that a company has over its competitors.